Hello, thank you for joining us today. My name is Karen and I'm on the marketing team at ESPC, and I'm joined by Kenneth Murphy from St James's Place Wealth Management. We will be hosting a later life planning webinar today. So the way the webinar is going to work is Kenneth will kick off with a presentation to give you an overview of everything we're going to be talking about, some information about the services he offers and so on. And then we're going to move on to a Q&A. Thank you for those of you who have submitted questions in advance. We will do our best to get round as much questions as possible. We've grouped them together just if some overlap, there were similar themes, but if there's anything that you'd like us to cover in more detail or anything that we've not mentioned, please just drop a question down at the Q&A chat box at the bottom of your screen, and we'll do our very best to get round to them at the end. If there is anything you would like to know privately on a one-to-one level, please feel free to email either myself or Kenneth. Kenneth's details will be up on the screen in a few moments time once he's finished his presentation, and we can do our very best to answer and help you with all and every question that you may have about later life planning. So we will kick off with Kenneth, who's going to start with his presentation.
Great, thank you very much, Karen. Let me seamlessly share my screen with everybody. Okay. All right, well, thank you very much for joining us this afternoon. It really is appreciated for taking the time and coming to listen. Like Karen said, I'm going to go through this presentation, but if there's any questions throughout, by all means, put them into the Q&A or the chat box, and Karen will collect them and will ask me at the end. Okay, so what the agenda for today is, I'm going to talk through just a little introduction to who I am and my background. We're going to talk about managing cash flow, planning in retirement. We're going to talk about investment management. We're going to talk about tax and estate planning, and then I'll explain what kind of services and fees you could expect for this. So my name is Kenneth Murphy, and I am a partner at St James's Place Wealth Management. So a little about myself is I was a bank manager for 10 years, working in multiple branches around Edinburgh City and spending my last few years on Princes Street. So I managed all areas of banking, mortgages, savings, personal business banking, mortgages and investments. And I also spent a few years managing a building society, and I was learning a whole different side of finance in terms of end-of-life planning, like funeral plans, wills and powers of attorney. So following all of this, I did a diploma in financial advice, and I have aligned my business with St James's Place Wealth Management. I'm now celebrating 4 years here at St James's Place. I enjoy it a lot. It's great work, but it's great to have that relationship with clients going into the future and helping them make a difference. So the reason I tell you all of this is just to let you know and to see the experience and the background I've had, that I'm able to bring all of this to the table when helping you make your decisions. Also, a little bit about St James's Place. Now, I don't know how many of you will have heard of St James's Place before. We are like one of the UK's best kept secrets, but we are one of the largest financial advice firms in the UK. So we are one of the 100 FTSE 100 businesses. Now, the FTSE 100, that is the largest 100 businesses in the UK. So we are one of them. At present, we're holding over 150 billion of clients' funds under management. And we tell you that, again, just to introduce you to the fact that we attract our clients, they stay with us, and we continue to grow their funds, and we continue to attract new clients as well. We grow year on year because of the relationships we build, which we're really proud of. So we focus on building long and lasting relationships. Our solutions have no template. They are created solely to match your needs and designed around you. So to get into the detail of today, we're going to talk about managing cash flow first. So there are many stages in the life cycle of a client. Today, I'm focusing on the stage before retirement and starting retirement. An area that is fundamentally important to people is understanding, can you actually afford to retire? Everyone says the biggest financial commitment you will ever make in your life is your mortgage. well, I think your pension should also be, if not as much as important as your property is. Sometimes your property is your pension, and that all depends on your personal circumstances. But to know if you can retire, an understanding of your cash flow is how we do it. So this is a service that we will provide our clients to give them the assurances and the certainty that they can go into retirement and that their funds will continue to last for the rest of their life. Here you will see from this slide, it is a colorful representation of a couple's income and outgoings on their approach to retirement and in retirement. So I'm going to spend a little bit of time on this slide for you just to explain what a cash flow looks like. So let me get my little laser point. Okay, on here, you're going to see the stages before retirement, the years before retirement is this turquoise on the axis here. This purple, this is in retirement. So this is probably the most, well, both of them are very important. But again, when people are wanting to retire, they want to know that their funds will last. Here, this dark blue, that is their employed income at present. This turquoise line that goes throughout the life of the clients is their basic needs. And this black line that goes throughout the slide is what they actually want to spend. It includes luxury items, holidays, etc., etc. So you can see here their basic need and their luxury need, their total need, is less than how much they're earning. So they're able to save. They've got more income coming in than they need to spend. So they are saving right now, particularly in their years coming up to retirement. So you can see here at their ages, they hit retirement. So it's a staggered retirement. They're not the exact same age as 68, or they're 64 and 66. So you can see that there is a dip in their need of spending. But when they're, so this light blue for their entire life is their pension income. You can see in the first couple of years of retirement, they're the yellow here, that's their savings. So they had a bucket list that they wanted to achieve when they got to retirement age. They wanted to do traveling, they wanted to do the things that they never had a chance to do when they were working. So they needed to add their savings on top of their pension income to get all of the total costs that they wanted to do. But you can then see in the years following, their income that they need is the same as their pension income. So everything is breaking even, it's perfect. They then get to a stage here with this orange here. This is your state pension, or their state pension when it kicked in. And you can see it continues to grow with indexation each year. But as the years go on, their need stays here, but the income they're receiving is up here. So they are receiving more income than they need, and it is set for life. Here is some trust planning. So a bigger cost need because they're doing some trust planning, usually done to give 7 years 7 years notice before death. But obviously, you know yourselves, that can't be planned. But we planned it in here for 7 years before death as a minimum. Again, their cost continues. And you can see there's a division here of their cost. Their basic need reduces, but their actual total cost increases. This is us planning in care plans, okay? Again, you can see their pension income isn't sufficient. This yellow, their savings again, is being topped up to plan in for their care home fees, okay? Obviously, this may not be needed, but we have planned it in just to be absolutely certain, and then it is end of life. With this kind of flow chart, it really gives confidence to our clients to know that we have taken into consideration multiple factors within this to allow them to see and to demonstrate that they will have an income for the rest of their life, which is what the security everybody wants when they're making that big step into retirement. What incomes will you have in retirement? So you will have guaranteed income options. Okay, let's take a quick sip. You will have state pension. You could have, most people will have state pension. You could have a defined benefit, which was also known as a final salary pension, and you could have an annuity. So an annuity is when you've got a pot of a pension pot, you can use that pension pot to purchase an annuity. It's an insurance, and you give your pot over and they will then give you an income for life. So the benefit of these is you've got guaranteed inflation-proofed income, you have no investment risk, and you've got no need for regular reviews. You can just continue into retirement knowing that income is going to be incoming for the rest of your life. Then you've got flexible pension drawdown. So when pension freedoms was introduced in 2015, pensions have never been more flexible, therefore giving individuals greater choice at retirement. It's always worth exploring these options to see if they suit you, if they are right for you, and getting financial advice on these is quite important. But the benefits of this is you own your investment pot. So you're not using your investment pot to buy an annuity, you're using it to manage yourself flexibly. And you can make decisions on this. You've got more choices in terms of how you withdraw from that pot. You've got death benefits, so your loved ones can inherit whatever is left over in that pot. You can have tax planning in terms of getting financial advice and withdraw tax efficiently. There is no guaranteed income. It means you are in control. If you don't need an income, you don't need to take one, leaving the pot to be inherited, whatever is left over. Like I demonstrated in the slide here, where their income was too much, you wouldn't need to withdraw if you had a flexible pension pot. Okay. There are other incomes you can use in terms of your financial planning, getting into later life planning. There is deposit interest, ISAs, dividends and interest, rental income. So there is a variety of ways that we would incorporate a plan for your income in retirement. Investment management. So as people face retirement, it becomes the time where their earnings are at their highest, their mortgage is complete, and they are saving far more than they are spending. When they reach retirement age, they potentially get a lump sum from their pensions. So all these savings can be sitting in a cash deposit account. And in their current environment, and actually as history has proven, it's often not growing at a rate it could be, or even beating inflation. And I mean, in today's current inflation market, we understand how much of an impact that can be. You want, or you at least want to attempt to allow your funds to be growing at least at the rate of inflation. This slide demonstrates 4 asset classes. Now, let me just make this a bit bigger for me to show you here. So this is showing you if you invested £100,000 in 1987 up until most recently, but I think this is in 2021. It's to show you how it has grown. So you can see when you invest, there is volatility. So there's ups and downs all the time. And I think this slide has never been more important than right now, when we do actually have war in Europe. We are potentially going into a time of recession and just volatility and uncertainty. So I guess it's to let you know, this is not investment's first rodeo, okay? We have seen from these points on here, we have seen times in history of war, of recession, and it's to demonstrate that yes, the economy can get impacted. You can see these dips, but it recovers, okay? So in 1987, when £100,000 was invested, the value of your investment is up here, okay? Multiple 100%. You can see the impact that happens when we do have a war, when we have recession, etc. So there is a dip. So if you invested here and there was a dip, not overly significant. If you invested here, but obviously a dip, you would feel it. So it's making sure that you sit tight, you hold out for the recovery. That's the most important thing. So if you have heard of people losing out, it's most likely because they withdrew when there was a dip, okay? But as history has proven, we generally recover, okay? But you can see on here, the assets that we use are equities, commercial property, bonds, and you can see cash and inflation. So on here, this is cash along here. This is inflation along here. This is bonds, fixed securities, and then the red line is equities and the blue line is property. So you can see equities and commercial property have done the best performance historically over the years and continue to do so, and we expect them to do so going into the future. And that is why we choose investments over cash. It generally brings back the greatest returns. And most pensions are already invested in this. So when investing with me, I would seek to understand your preferences in these areas and deliver an advised solution that will be aligned to these views. So an investment is built around your preferences, even your ethical preferences, and we would meet as a minimum once a year to review the investment and your circumstances at that point. So we discuss performance, your attitude to risk, your cash flow, your estate planning, but most importantly, we want to know how you and your family are, what are your goals, what are your plans, and do we need to amend your plan or your goals and your finances, or your investments to achieve those plans if there is anything new. And as you know, things change so frequently from year to year, and being able to have somebody to help guide and advise for any changes that happen can prove to be really important. So at St. James's Place, we have an array of blended strategies to help generate growth or income for all of our investors. So those with longer to invest or who have a greater comfort with volatility, they can sometimes take a greater risk. Sometimes if you are approaching retirement pretty imminently, the risk you may wish to take would be less, okay? So this is to demonstrate the portfolios that we have at St. James's Place. Now, these are pre-designed by our investment committee, okay, of experienced individuals for many years within the financial field and investment field. But while these are templates, these are pre-designed with the greatest amount of diversification, the lowest risk with the best potential for return. We can still make bespoke solutions. So we definitely want to take into consideration your preferences, particularly ethical preferences, and we can bring in different funds and whatnot into these portfolios. But down here, you can see these are our in retirement portfolios, okay? You'll see the risk level of portfolios go from low to high. Now, generally, we don't have any clients who want low risk, because in general, that would be cash, okay, which you can access without investing and without needing to pay, okay? Generally, we don't have any clients who want high risk portfolios either, because they want to have a gradual grow without much volatility. So we don't have any created portfolios in high either. So we range from lower to upper medium, okay? These ones here, these are all our growth portfolios. These ones up here, these are our income portfolios. So if you wanted to receive an income from your investments, we would start talking about these portfolios and create a solution that's right for you. And these ones down here are designed specifically for people in retirement, okay? These portfolios are designed with the retirement folk included, okay? Again, all of these can be amended to reflect your preferences. So, but that's how it generally looks. So you may think, right, I might be lower medium. We would discuss that kind of portfolio and let you see what that looks like. Each portfolio has about 10 funds within it. Each fund is managed by a globally revered fund manager, and each fund holds about 50 different companies within it. So in your portfolio, you will be invested in approximately 500 different companies. So the idea is some of them will perform excellently. The majority will perform well, and some will underperform. But what that gives is an overall gradual good growth by having invested in over 500 different companies. And that is the diversification that these companies give. They're also actively managed. So those fund managers that I mentioned, they are actively managing those funds and make decisions on a daily basis to ensure that they are invested in the best possible position for you at all times. Okay. And I will talk more about fund managers and the options in, if you ever want more detail on that. So tax planning. Tax is a certainty. We come into the world, we leave the world, and we're taxed in between. So however the government want you to plan for your future. And so they make pensions and certain investments incredibly tax efficient for this purpose. As you know, we have a growing, aging population, and to be able to afford to keep state pension at the levels that it is going to be very expensive. So governments want people to have their own personal pensions and to understand them and to give them the greatest benefits to make sure that they pay into them, which is why pension planning is one of the key areas that we talk about as financial advisors. Pension taxation. So you receive income tax relief on the contributions that you pay into a pension. For example, if you were able to maximize your £40,000 annual allowance into your pension, £50,000 would be invested immediately. Okay, that has been given to you by the government and will continue to grow. And that growth, all growth in your pension is tax efficient. You do not pay any kind of tax on the growth in your pension. It is also inheritance tax efficient. So your pot of money, that is your pension, that can be passed on to your loved ones outside of your estate. So it is not included if you die in your estate. Your pension pot is kept outside of the total. Okay, so it's very tax efficient in terms of IHT. You also receive a 25% tax-free cash lump sum if you wish at retirement. There is drawdown options, which means that you can keep your income at a tax efficient level that is right for you. Again, getting advice might be needed to do all of that, but again, it makes it tax efficient. You have an allowance each year. We all have an allowance. It does depend on how much you earn, but in general, you can put in £40,000 into an ISA, and you've got a lifetime allowance of over £1 million. You've also got allowances for ISAs as well of 20,000 per year, which you may want to consider if you're maximizing your pension. Okay, but very tax efficient solution planning for pensions. Now, service and fees. So some people are happy doing life DIY, from their homes to their cars to finance, and can do a great job. Some people, they prefer to get advice from experts to give them peace of mind, guidance, and just reassurance, and to help them make those big decisions. So if you are one of those, then just to let you know what the services and costs could potentially look like. So what you will receive from St. James's Place is full portfolio management, active fund management from world-class fund managers monitored by St. James's Place, your platform tax wrappers, your allowances are managed for you, premium service, face-to-face, immediate email and telephone contact, a relationship that you can trust and is long-lasting. And for all of this, if it is a pension, for instance, the annual management charge is approximately 2% each year. Okay, every single pension has an annual management charge that you may or may not be aware of, that you're not even receiving advice on. So you get everything included for that 2%. It is all in. Okay, we are very clear and transparent about our costing. There is nothing additional that you need to be aware of, and we're very proud of the value and the service that we deliver in return for the cost. In summary, I have discussed today managing your cash flow, investment management, tax planning, and the services and fees. So that is what we will be looking at going into and planning for somebody's retirement, which can make the biggest difference. Obviously, there is a whole load of other things that we can talk about, but to keep it nice and simple today, that is what we focus on. If you do want to talk about anything anymore, each case, like I said, is individual and your circumstances will all be different. But my details are on here. That is my email and my mobile. They're the best ways to get in touch with me. If you've got any questions, obviously you can send them into Karen just now and I will answer them, or you can contact me direct. Okay, thank you very much for listening. Appreciate it.
Thank you so much, Kenneth. That was brilliant. And don't worry if you never manage to grab the details, if you don't have a pen and paper handy. We will send out an email after the webinar is done, either later today or tomorrow, with a recording of the webinar, and I'll also add Kenneth's details at the bottom if you would like to contact him directly. So now we're going to move on to the Q&A section. I'll ask Kenneth the questions that we've received in advance of this webinar, but like I said, please do ask us questions live and we can try and get back to you before the webinar ends, and that includes anything Kenneth has touched upon. So the first question, Kenneth, is how early should I start planning for my retirement and things like inheritance tax?
I mean, believe it or not, the government will allow a newborn baby to have a pension. So it is probably as early as that, but my answer to people when they ask is now. You know, if you're asking the question, now is the time. So your pension planning should start as early as possible. Obviously, I know that we can't all do that, but you know, just to give yourself a sense of urgency, if you're thinking about it, then you probably should be doing it.
Brilliant, thank you. Next question. What's the best thing that I can do to make my retirement as easy as possible?
You know, I kind of just touched on it there, but receiving advice makes such a big difference. I just know from my clients and their experiences, they're just so grateful and appreciative for understanding their pension, understanding that they know that they can retire, that their money won't run out, and how much freedom that gives them to allow them to make all the decisions that they can. And also, you know, it really is that hand-holding moment where they can make the decisions, but you know, you're just in the background telling them it's fine, go. So I think advice will help people the most in the retirement. And one thing to add is it may be me or it may be any financial advisor you like, but find someone that you know, like, and trust, because it should be a long-lasting relationship, because you want to do this planning for the rest of your life. And I know that your financial advisor will potentially leave or will potentially retire themselves, but knowing that you've got them for at least 5 to 10 years will make a big difference, because they'll know you, they'll know your life, they'll know your plans, and it just makes everything so much easier, and it'll keep things more stable for you as well.
Brilliant. Next question. How does equity release work in practice?
So I am qualified for equity release, in fact. But equity release is not necessarily right for everyone. Okay, so just to put that out there, to give sort of a case example, a person or a couple who potentially don't have any children and are not planning to give inheritance away, but that doesn't have to be the case. But if for this case, so they are living in a property that is worth, say, £700,000, but they've got limited pension funds or pension plans to enjoy their retirement, because they have no intention of giving any inheritance potentially to maybe like nieces or nephews or potentially charity. They want to use the value that is in their property, but stay living there. So they can release that equity at some point in the retirement if they wish, and use those funds to enjoy life in retirement, and potentially not have any value in their property when they actually pass.
Brilliant. Thank
Does
you.
does that help? Does that answer it, Karen? I hope it does.
Yeah, I think so. And if anyone would want us to expand on that a little bit further, please just say, but I was happy with that explanation.
Thank you.
All right. The last of our pre-submitted questions. To help keep the inheritance tax bill down, should we pass our share of the house to our children when either of us dies?
Well, if you're a couple and you are as a couple, you're going to have a married allowance anyway. So it's going to be £1 million if your house is being inherited by a child. So you've got that allowance anyways. If you're going above that, irrespective of if you have passed your 50% of the house to a child or not, it's still going to come into that £1 million of inheritance threshold. So probably planning before that would be advisable if you're wanting to prevent any inheritance tax costs. So I think planning in advance rather than waiting until death and wills would potentially be more beneficial, if I'm honest. One thing I will say is that every single case is different. So don't take this as, you know, advice for you. If you do want a particular question answered, get in touch so I can understand your particular background, so I can give a clearer explanation for you. One thing just to add as well, you know, because even my own family will go, oh, but sure, how much will it cost if we have a meeting with you, or to find out, you know, to get answers? You know, there is no cost to come and to ask some questions. There is no cost to have a meeting to understand what your situation is and to see if we're able to help. If we're able to help, we can let you know what that may cost, and you can decide if it's right for you. But sitting down, having a meeting doesn't cost anything, because each individual case is really important for us to understand before we can give advice on it.
Brilliant, thank you. And it looks like we've got one question just before we finish up in the Q&A box. And that's, what would you recommend as a short-term saving plan to offset current losses in stocks and shares ISA?
I mean, I know that stocks and shares ISAs have probably had a poor performance since the start of the year, and multiple reasons: cost of living increases, war in Ukraine, etc. But as Warren Buffett would say, if you are worried about your investments, now is the time to invest then. So, like for instance, when the stocks are high and the economy is high and performing, say 100 units will cost X amount. So right now, those 100 units are costing much less. So now is the time to buy them, because we do expect that it will recover and they will grow to that value. So now is the time to invest. However, if you are cautious, if you're nervous and you don't want to do that, the cash options are not great, although interest rates are getting better. Things like using your cash ISA allowance, things like National Savings and Investments, NS&I, there's premium bonds, I'm sure everybody will know those. Those kind of options are available to you and will keep things tax-free. You're using your cash ISA allowance, but putting funds into your pension now as well would be a tax-efficient solution. And if the stocks are low, then you will be buying at a better price just now.
Brilliant. Thank you so much. And I think that's all of our questions for today. So I would like to thank you all for coming along and joining the webinar and being interactive with us and asking us questions. And of course, a huge thank you to Kenneth for spending his time today to give us that fantastic presentation. Like I said, I will follow up in an email with all the information and a copy of this recording for you guys to review. Please fill out the survey that will pop up at the end when you close the screen. That's so helpful for us to decide how we can change things and make these webinars as informative as possible for you. And please do keep an eye out for future ESPC events. We have one next week on Thursday the 30th, which is our June property market updates that will be covering the whole property market over the last quarter, and some advice from other experts as well. Thank you so much again, and we'll see you soon. Thank you, Kenneth.
Thank you. Bye.